Welcome back. Core sector output has contracted 0.4% in the month of March. It's the first contraction in 5 months. Anita Ranjan is the Chief Economist at RBL Bank. Aditi Nayar is Chief Economist at ICRA, and both are with us to talk about this. Thanks very much, ladies, for being here on the program. Anita, if I can start by asking you, is this, in a way, an indication of what is to come? Because, I mean, the real entrenched impact of high energy prices is only going to start to show up in the months to come. The conflict started late February. March, of course, people were still kind of sort of figuring out when, how long this is going to go on, and a lot of curtailment, adjustment, etc. has happened since. So what is your sense? How do you read these numbers?
So obviously, first of all, thank you for having me on the show. And obviously, these numbers kind of indicate the war impact in March. So if we break it down into various components, if you perhaps start with fertilizer, a 24% decline is obviously after a steady growth for maybe 2 years. It's clear indication that obviously input natural gas was not available, which is why the curtailment in availability has hit them. Secondly, if you look at sectors like natural gas, for instance, which has grown after almost 2 years of decline, about 6%. There again, it's like push because of the absence of import availability. Petroleum products are clearly flat, and they were already before this war impact as well. Now, if you look at electricity prices, it's also a combination of slowdown in manufacturing activity plus rainfall in some of the areas. Then if you look at steel and cement, which was going very gung-ho for the last, almost 6 months, we saw even double-digit growth in some of the months, has slowed to a 2 to 4% kind of a growth, which is possibly also the impact of the fact that construction activity must have slowed down because Morbi segment, the ceramic segment, obviously did not get gas, and overall slowdown in activity has hit this sector as well. But now coming to what we are looking at prospectively, compared to March, now fertilizer, from what we hear from the government and what government has put out, 90% of gas is now available for fertilizers. Almost 70 to 80% is available for industries compared to what it happened in March when we started with 40-50%. It started getting.
Anita, sorry to interrupt you. That seems a little. I don't know how. It's good news that it is improved. Availability is better, but how is it better, and will it stay better?
Yeah, because government is obviously diversifying its imports from various countries. So the question is about the cost. Obviously, it's going to come at a higher cost, but from what we understand, bulk of the cost, especially for fertilizers, will be absorbed by government, and rest will be a pass-through. So they are contracting from the spot market. They are going and diversifying with various countries. So that's where they are able to kind of navigate through the overall phase. And mind you, they're not even cutting it for consumers. So things will not be as bad as March. Say fertilizer won't decline by 24%. We may still see a moderation, but I would think that things will start to normalize. Cost impacts will definitely, so that's a separate picture. Cost impact will definitely start to hit in some way or the other.
All right, let me get in Aditi for a quick word in as well. Aditi, go on. What's your assessment about what is to come?
So, just in terms of, if we just wrap up the March quarter itself, firstly, we're looking at a 1 to 2% growth in the IIP, so much lower than the 5% growth that we got in the previous month. And on the GDP side, we're looking at a print of just around 7% because too much of the margin impact may not be there in the March quarter. I think it will be felt a bit more in the April quarter unless things resolve very quickly. So we're looking at a 7% GDP growth for Q4, and that would bring the full year GDP growth to 7.5%. So that's just wrapping up what that quarter would look like. Now, if I delve into the data, core sector gives us the production side data, and we have a whole host of other high frequencies that give us more of the consumption side of the economy. So here there is a dichotomy which has come in the March numbers. Clearly, it is the production side that got hit, whereas a lot of consumption side indicators still held up. So steel production growth slowed down quite a lot. but the demand growth on the consumption side was still very high. Similarly, petrol and diesel consumption growth was still very high because, you know, there really wasn't that pass-through to higher prices, so that signal in terms of prices was not there, and availability was not really constrained on the petrol and diesel side the way that it was at least for some time on the gas side. So it's a mixed bag. I think overall, you know, we are going to see sort of K-shaped impact on different sectors, definitely where prices have gone up a lot and availability is a concern. That is where you will see the higher impact. Then there will be sectors where prices are high in terms of inputs, but availability is not so much of a concern. So the impact would be more muted. We're looking at three scenarios to model GDP growth for FY27. So the first we're calling crude at 85, and then we're looking at crude at 105 and $125 per barrel. For what we are actually buying in India, not the mechanical Indian basket, but the actual cost of imports. So at $85 per barrel average for the full year, we are looking at GDP growth coming in at 6.5%,
Right.
5.8% for 105, and 5% if it averages as high as $125 per barrel for the entire year.
You know, we would have loved to go on, but completely out of time. Thank you very much for joining us, ladies, for you know, that assessment of on the economy. Well, Grow reported numbers and it's been a very strong set. Ishant Bansal, co-founder